really, I think what everyone in the chat is already getting on are these Wealthsimple ETFs. So let me just jump right into that. So Wealthsimple has had socially responsible tier for a really long time. They launched it in, I think it was 2016, 2015, 2016. And this was one of my first sort of big articles that I did. It's not even, I don't have the search because I'm logged in. So I have to do Sustainable Economist Wealthsimple SRI. And I wrote one of my top performing blogs of all time, which is How Sustainable is Wealthsimple's Socially Responsible Portfolio. You can see this was April 2016. And, the too long didn't read is that, it wasn't great, straight up. It used CRBN, which I do have a question on this, so I'll talk about this ETF in a little while. But, it had a lot of things that I didn't like. Philip Morris, Tobacco, General Dynamics, Monsanto, Walmart, Nestle, all these things were in here, which I really wasn't very happy about. As well, this VIDI, International Equity, it was just very, very strange in here. Had Gazprom, which is Russia's largest natural gas company. So it was socially responsible. What they've done, and Mike, thank you for responding on this, that, I gotta say, they're pretty open about the fact that they know it wasn't great. And they wrote a little piece in their magazine. This is 2 days ago. It looks like this launched. This was June 16th. So yeah, 2 days ago. And, they acknowledged that it wasn't perfect. So what they did is, transparently, we realized there was a problem with their SRI portfolio. One of these sort of no shit Sherlock moments that, I told them about 4 years ago. But in fairness, there weren't a lot of great options. And they couldn't find an outside fund that really did what they wanted it to do. So last year, they started building their own ETFs, which to me is a really, really cool thing. Wealthsimple has been expanding in a number of different ways. They bought something called SimpleTax, that is a tax software solution that I personally use. And so this was last year. So Wealthsimple doing investment stuff, but buying this tax software, was a signal that I think they're trying to grow their business and expand into other areas of personal finance. So, they went ahead and they built their first ETFs. So there are two ETFs for the global, to get global coverage. And their model portfolio, we can look, but really it's very simple. It's these two ETFs plus bonds. But this is the Solactive Wealthsimple North America Socially Responsible Factor Index. So this is the specific index that they're tracking for North America. And then they also have the Solactive Wealthsimple, this is going to be Developed Markets X North America Socially Responsible Factor Index. So this Developed Markets X North America is a fancy way, often an acronym that'll pop up is EAFE, Europe, Australia, and the Far East. The Far East being Japan and Hong Kong. So it's not going to have China. It's not going to have companies on the Shanghai Exchange. It's not going to have India or Brazil, those emerging markets. But it will have the rest of the world's developed markets. And then it's X North America because, of course, we're going to get our North American exposure through this ETF. So they just split it 50-50, half into North America, half into this other one. And this allows us to see exactly what's inside the portfolio. Now, it's a little bit annoying. I sort of struggled because I wanted things by, it kind of gives it to us by alphabetical and then by these index shares, which is a really strange methodology. It depends on the share price. So that was kind of useless. So I reached out to Wealthsimple and they told me that they updated. So this is at the end of the day yesterday. They published this morning, I think knowing that I was going to ask some questions. And this gives us the full list of companies with the index weighting. Now, as we go through this, I'm going to look at it through two lenses. First, on the sustainability side, because to me, that's what I like looking at. And then secondly, we will look at it on the financial side, because there are a few things buried in the index name that give us some clues in terms of their methodology. So really, when we look through the companies, first, I can show you the things that they specifically wanted to exclude. So let me just see. They decided they didn't want to do ESG. That they felt that the ESG, is process right now is flawed. That they rank companies within a given industry, right, and then invest in the highest scoring companies. They don't like this approach because they talk about it being responsible relative to other companies within a given industry, which I totally agree with. Instead, what they did is they created their own negative filters. So what they did with theirs is they created a number of negative screens, okay? So they absolutely get rid of thermal coal mining, coal power generation, as well as oil and gas related companies. So this is what I would consider fossil fuel free. It's too young for me to do the extensive screen yet, but it does look pretty good in terms of being fossil fuel free. They got rid of the top 25% of carbon emitters within each sector. Oops. So again, it's not about the ESG score. Instead, it's really about getting rid of the top quarter, like the worst 25% across sectors based on carbon footprint. From there, UN Global Compact, these are going to be major controversies. They get rid of weapon manufacturers and defense contractors. And then as well, the quote-unquote sin stocks, tobacco, alcohol, gambling, adult entertainment. It kind of cracks me up with gaming. I know a lot of people who are gambling have probably migrated over to Wealthsimple Trade and are starting to do options trading. To me, this has always been a bit of a funny thing, but these are the very standard sin sectors that are normally omitted from these ETFs. And then to me, the thing that really stands out, this is the biggest thing, as far as I'm concerned, they really push the agenda forward on gender diversity on the board of directors. That typically this is not something that's addressed at all, or it's like buried somewhere in the ESG score. There's the one fund from Horizons, ETHI, that required one woman on the board of directors. Bit of a token problem there, perhaps. In this case, companies must have more than 3 women or more than 25% of their board of directors has to be women. So to me, this is awesome. I did research 12 years ago about gender diversity on the board of directors. And that what we found is there's a huge amount of evidence that suggests that gender diversity boosts company performance. We can measure it in a couple different ways: return on assets, return on equity. There are a few different studies, these are just kind of the top headlines here. But what we found is that, basically a bunch of academic studies suggest the presence of more female members. This is too bad. This is kind of against my findings. Anywho, many popular press articles and fund managers make the claim, right? So McKinsey, Thomson Reuters, Credit Suisse, it looks like this person might have a different idea. So it'd be curious, this is one thing that I would say is up for debate. However, in my experience, gender diversity does have a positive correlation to positive return on equity. Is it causation? Are they more profitable because they're more women? I can't tell you that, but what I can tell you is from my studies, now this was 10, 12 years ago, but out of all the ESG issues, the one most strongly correlated to financial outperformance was gender diversity on the board of directors. So to me, this is kind of a cool thing. And I think that, a lot of people are going to be really surprised about this. When I spoke to Wealthsimple earlier, I asked them about these screens. Like, these are pretty intense screens, and they said it screened out about 60% of the universe. That fewer than half of the companies made it through these screens. And in fact, I asked about why they did the North America fund instead of doing a Canada plus a US. How normally it's like Canada, US, EAFE, Europe, Australia, Far East. In this case, they did North America because there weren't enough Canadian companies getting through the screen. That the gender diversity on the board of directors here in Canada is horrible. So that's why they decided to make it a North America ETF, which in my mind is better. Hey, I'm happy with 2 ETFs rather than having to buy 3. So that's like the methodology. That's what they're doing in here. This is not a thematic fund. This isn't going to be sort of green technologies, things like that. A few companies will make it through by default, but I want to be clear that in my language, this is not a doing more good ETF. This is very much a doing less evil. This would be the core holding within a portfolio, and then we could then carve out part of our portfolio for thematic investments in green technologies, water infrastructure, etc., if we really wanted to. So when we look at the North America, let's look at the companies that are inside. I can see here Hydro One is the top holding. Hydro One, Canadian company, and this speaks to me as some pretty remarkable that Hydro One would be in there. A couple things stick out from this. So number one for me is that how the heck is Hydro One, which is not a huge company, so heavily weighted? The reason for this, and I was able to confirm this, is that if we look at the index, you'll notice that they say it's something called a factor index. What this means is that most ETFs, most indices, are weighted by something called market cap, which is the size of the company. This one is not weighted by market cap by the size of the company. Instead, they use this thing called a multi-factor approach. You can just Google this idea of multi-factor. It's the FAMA French 5-factor model, that this is like a famous thing, and that there are all these different, financial metrics that they're evaluating. What this means is that the biggest companies aren't going to be at the top, that you can have Hydro One in here. Notice that number 2 is Agnico Eagle Mines. So again, this is a mining company that gets rid of fossil fuels. It's not going to screed out mining, but it is going to get rid of the worst quarter by carbon footprint. It's going to get rid of any mining companies with major controversies, right? And then sort of human rights abuses. And then any mining company that doesn't have at least 3 women or 25% female representation on the board is out. So, again, there are going to be some things that are questionable in here. And obviously, it's going to be up to you to ask yourself, are these deal breakers? Coca-Cola, General Mills in here. Again, lots of sugar and Coke. So that is going to be an issue for some clients. Really, it's going to be the major flags. And if there are any companies in here that you want me to dive deeper into, to learn what they do, or to show you their ESG, I'm happy to do that. You can see Canadian companies like Shaw, Loblaws, and Magna are in here. I've noticed that it doesn't have a lot of the big banks. However, you can see Amazon is in here. And Amazon is a very contentious company, right? This is one of these issues where, a lot of people have a deal breaker when it comes to Amazon. However, it does make it through this methodology. So it's never going to be perfect. They kind of had to make these choices between how strict do we want to go, and then in terms of financial performance, how strong are we trying to make it to find that balance. Amazon is always a great example because obviously the stock price has done just remarkably well, right? And you can see in here, if we look at the 5-year performance on Amazon, from $6.40 a share up to $2,600 a share right now. And I'm someone where I purposefully don't buy from Amazon if I don't have to. I'd way rather buy directly from the seller or from a different retailer. That said, would I be willing to sacrifice this financial growth, right, in my investments in order to not own Amazon? That's something, me personally, I think I probably would be okay with that. I would hope for a little bit more of some other companies like Shopify or, some that I feel are doing a little bit better on the ESG side. But when it comes to personal preferences, this is really going to be about you. This is really going to be about, are you willing, where are you on that spectrum? But, Amazon, I know, is going to be a deal breaker for some people. As I scroll through the remainder of the companies, Canada Goose, that's kind of funny. Bristol Myers Squibb, so there is going to be some pharmaceuticals in here. BCE, that's Bell Communications. I know a lot of the Canadian companies, Quebecor, things like this, but you're going to recognize Best Buy, etc. Really, it's fascinating to me. Netflix, Apple, Alphabet, which is Google, and Microsoft, right? Major companies here. Again, fairly small percentages. And it is what it is, but these companies are all considered sort of overvalued. They are more expensive stocks. So you can see how in this multi-factor approach, you're going to have less exposure to them. Where some of the other ETFs we've looked at that are cap weighted, these are the companies that are going to be right at the top of the list with the heaviest weightings. Facebook is in here. I know some people will probably have some feelings about that. But otherwise, those would probably be the major flags that I recognized. In here, there wasn't anything else that really sort of drove me nuts. Bank of America does squeak through, PNC Financial Services. So, but again, I don't see any of the major banks. My guess is that they didn't meet the gender diversity screens, would be my guess. It would be fascinating to look at something like RBC, Board. I'm just curious. I don't know this is the case. Okay, if you want the fees, Gail, I see that question. I will get to that. You're going to be very, very happy about that. But I'm very curious about their board of directors. So here we go. Okay, there's one woman, two women, three. Okay, so it wasn't the gender diversity screen. Fascinating. I'm actually impressed here. So, very, very curious there. Okay, good news is that in terms of the fees, and this is where it gets a little bit awkward because I don't think they have it in the, this very specific, like it's not like a normal ETF page that other ETFs page. They just did it in their FAQ. So the fees on it, I believe, are 0.2%. Here we go. WSRI, which is North America, is 0.2%. The one that's the rest of the world is a little bit more expensive, 0.25%. These are super, super cheap, which is awesome. I love that the fees are coming down. I can't tell you the balance between Canadian and US. I would actually have to go through and pull out the Canadian ones and do the math myself. I think just because they don't have those breakdowns. Let me see if it's popped up on Morningstar. I checked a little bit earlier today and it wasn't on there, but WSRI, I believe, is the ticker symbol, and it's just not in any of these databases yet. So in a future date, I'll be able to get you data around the sector balance, the geographic balance, the carbon footprint, all that fun stuff. That data will come likely within the next month. These aggregators will be able to pull all that data. But for now, we are really limited to looking at just the holdings. Duncan asks, can you buy it outside of Wealthsimple? Yes, absolutely. So these are ETFs. We can buy these in Questrade. We can buy them on whatever platform we want. It's just that Wealthsimple, the way that they've structured it is that these are available through their robo-advisor. So you can see they have these different things. So their Wealthsimple Trade, this would be the equivalent of Questrade or RBC Direct Investing or TD Webroker. You could buy it through any of those platforms. However, what's in my mind a big deal is that they do offer it through Wealthsimple Invest, which is their robo. So this is the thing where it's going to be automatic rebalancing for you. You can see they've got it here. Now, again, really the question for me, invest in a better world. To me, again, these are sort of the doing less evil approach. We're really getting rid of the worst stuff. If you wanted to add in your own ETFs, oh, that's interesting. Here it is. If you wanted to add in your own, doing more good ETFs, you couldn't do it through this feature. Instead, you can see here, if we were to do, let's say, a nice balanced portfolio here, you'll have your 35% bonds, and then they're just going to split it almost exactly evenly between the two. A little higher on the North America, but just barely. Even on the growth, you can see it is actually even, and on the conservative, you can see it is even. I'm guessing it was just for awkward numbers that they didn't make it absolutely even there. But so really, this is great because to me, this is going to be a nice, simple starter portfolio for people that don't want to bother with the rebalancing or anything, that you can do this. It'll be entirely in Canadian dollars and they will rebalance it for you. That said, if you are comfortable with ETFs and doing it on your own, even better, you don't need to pay the robot. Instead, you can just use your online broker, or you can use, a simple trade that these are ETFs that are in Canadian dollars, that between two ETFs give us that global diversification, and, in my mind are pretty darn good when it comes to a sustainability perspective. Let me go through the companies in the ex-North America, just because I do think that that's a worthwhile exercise to do. And then I do want to talk about what I would consider to be the downsides for them. So I can just show you the international ones. Again, it's not going to be the biggest companies at the top, right? Husqvarna, Electrolux, they're a Swedish company that I love. They were part of a case study I did in Sweden. Adidas, which I know has a very high ESG score in the apparel industry. If I'm honest with you, I don't know as many of these companies. Novartis is going to be pharmaceuticals. SAP, this is like a German software company. Oh, Christian Hansen Holdings, I do like them. They do some cool things in the food sector. So again, I'm not seeing any major red flags. In fairness, I don't recognize these companies as well as I do the North American ones. It's just not my universe as much. But I know companies like Deutsche Post have a really high ESG score. Nordea Bank is going to be one of the top banks. So really I would say that this is very, very impressive. That from a sustainability lens, I'm happy. The last thing on a sustainability side that I am happy with is that I've spoken to them and that they've hired a firm called, what is it? I want to call it SSI. Hold on, I had it in my notes here. Where are my notes? Yeah, ISS. I got that wrong. I was like, SSI, that's Strategic Sustainable Investments. That's the name of my first company. So it's not, it's a shareholder. So they do institutional shareholder services, ISS. This is the company that Wealthsimple works with to be able to do a lot of the screening, and they're getting some of that information. What's really cool is that ISS does do really, really good proxy voting services. So I'm encouraged because this has been a bit of a problem when it comes to ETFs. BlackRock hasn't been great. Vanguard has been quite horrible. And I am doing a little bit of research this summer into this. But I am pretty happy. I think that they are going to be pushing these companies in a more sustainable direction. So kudos to Wealthsimple. It's pretty amazing to me that they've created this product with multi-factor, pretty deep analysis with shareholder engagement, and they're doing it all for 0.25% fees. Really, I can't imagine they're making a huge amount of money when it comes to the fees. I think what they're trying to do is build the brand and bring people to the Invest platform with the robo-advisor, which means that for those of us that would buy it directly through Questrade or another platform, I think are going to be really good. I think that we're really going to benefit from that because it is such low fees. So in terms of the things that I don't love about it, it's really going to be interesting to see the breakdowns when I am able to see the sector breakdowns, the geographic breakdowns. But my concern is that there just aren't a huge number of companies inside of it that, for an approach that is supposed to be sort of like doing less evil and get us these broad market returns, I think there may be, 80 to 100 companies inside of each of them. So we're looking at, potentially our global equity portfolio of only about 200 companies. And, obviously we're trying to cut it down. That's what we want. We want to get rid of all the nasty ones. So losing out on that diversification, is probably a trade-off that a lot of people are okay with. But I got to say, I did assume that there would be more holdings in here. And that really, that I'm going to be watching this. The second thing is the weighting approach. The fact that it uses this multi-factor approach is fine. There's a lot of evidence that suggests it. But again, this isn't going to earn us market rate returns compared to something like the All Country World Index. That's not what they're trying to do here. They're not trying to track the S&P 500 or the TSX 60 or any of these standard benchmarks. They've really gone out and created their own benchmark. Now, from what I'm seeing, it seems to be a pretty cool benchmark. I do like it. But there's a lot of uncertainty. I can't predict future performance on this. And although I will say, I think it's really well positioned with the low carbon, with the gender diversity, that it really, the proof will be in the pudding, in the track record that it has. And I'll be so curious to watch these ETFs. The last thing that I'll bring up is that, a little bit disappointing to me that there are no concerns, although they do so much around gender diversity, there really is nothing around racial diversity. And this is something that obviously has just, popped up, or not popped up, but it's really come to light, I think, for a lot of us in a much more meaningful way over the last few weeks with all of the protests. But there, with such an emphasis on gender diversity, I'm sad that there isn't also at least some lens when it comes to racial diversity. Now, I did come up with it. I did speak to the chief investment officer at Wealthsimple. They're telling me that they are having these conversations within Wealthsimple with their index provider. Really think that there are going to be some changes to this potentially. I think they've designed it in a way that it will be flexible, that they could change or update that methodology. But again, because of the way they've designed it, I do expect to be something by to have a more turnover than an average ETF. That it's not always going to be the same companies and then with movement at the bottom. That this is something where these index weightings absolutely could change on this, right? So I can see that as a problem, and that there could be companies added or dropped off. That it's really going to be important for Wealthsimple to be completely transparent, not just as of June 17th in an FAQ, but to have this updated on, ideally a daily basis, so that I can see exactly what's inside this portfolio at any time, because it is going to change. I see a couple questions here. We can see this. Did the index page break down the sectors? No, sorry, Steve. They don't. It's frustrating. Now, there are some documents. I think I can get the fact sheet, and I wonder if it has the sector breakdowns here. Yeah, it looks like it does. So maybe we can get the country breakdown here. It doesn't look like it gives us the sector breakdown, but I wonder, Gail, back to your previous question, we can probably do this. So you can see here, composition by country. So that's going to be interesting. It looks like Sweden is really high. Yeah, SEK, Swedish krona, 30%. Wow. So 30% exposure to Swedish companies, and then Japan, Denmark, Norway. So really heavy when it comes to Scandinavian. I mean, it shouldn't be surprised given those screens, but pretty stark to see it there. So again, on the you can see why I want a little bit more data when it comes to these country breakdowns. Let's look at the North America one, the documents and the fact sheet, and see if it gives us the breakdown between Canada and the U.S. We do get it here, Gail. Look at this. So it's about 75% U.S., 24%, 25% Canada. So, very interesting. This would have what I would call a slight home bias. That, Canada, our market's about a tenth of the US, tends to be, maybe even smaller in some sense. So, this would be a little bit of a home bias by going with this North America approach. Wesley, yeah, Vulcan is third on the list. They don't even have a sustainability ESG report. DR Horton, same thing. This is not an ESG fund. So again, this is going to be a preference thing, where really I want to be clear, these are not ESG. That Wealthsimple looked at ESG, they decided it wasn't ready. There was too much confusion. There's too much, comparing it to other companies within their own sector. So really what they're doing is just getting rid of it on specific criteria. My question with Vulcan and DH Horton would be, do they disclose their carbon footprint? Because part of the methodology is getting rid of that bottom 25%. And that suggests to me that companies do need to disclose. So I would be very curious to see whether Vulcan and or DH Horton have done something like the Carbon Disclosure Project, such that even if they don't do ESG or sustainability reports, that they do publish that carbon footprint data. That's my guess here. Duncan for Swedish, Electrolux, Husqvarna. Yeah, I know, right? Let me see if I can get the companies. This is the North America. Let me go back to the developed ex-North America. So I think the trick here is going to be this security ticker, that this tells me the Stockholm Stock Exchange. So, I don't know if it's NIBE or NIBE. I don't know. Electrolux for sure, Swedish. Svenska Celluloska Aktiebolaget. I'm going to roll with that. That sounds right. I think I did that well. Latour Investment, Boliden, these all look like they are Swedish. Henkel, I'm guessing this is German. Adidas, I know is German, right? So you can see I kind of have to decipher it a little bit, but I'm guessing this would be Norway. I'm guessing this would be Japan. So again, it's a little bit tricky, but we do get some clues about what's inside of it. But I will tell you that I actually hadn't seen this breakdown by country before. And, my eyes are popping out of my head a little bit just with how much exposure there is to the Scandinavian countries. But then again, should we be surprised that they've just been so much further ahead in terms of disclosure, in terms of a lot of these issues? I think that my guess is if there are some problems or like problem companies, that they're actually going to be in the North America one, that they are going to be, companies like Vulcan or DH Horton or, other companies that aren't publishing a lot of sustainability data. It upsets me a little bit that they might squeak into something like this, even though they don't broadly disclose, but just because they, sort of were able to tick the right boxes there. So it is what it is. I'd love to hear your thoughts. What do you guys think? Thumbs up, thumbs down, thumbs sideways. Are you going to switch? Do you want to wait? I would suggest waiting. I would say give it at least a month until I can look things up on Morningstar and get you a carbon footprint and all that fun stuff. But I would love to know sort of where you're at. Gail, in terms of compared to my easiest pie portfolio, so if we're comparing this to DRFG, so let me just bring it up. I've got my easiest pie portfolio. And where is it? Here. And so, compared to DRFG, they both use the multi-factor approach. They're both fossil fuel free. To me, the Wealthsimple ones are a lot cheaper than the Desjardins ones, and they seem to be somewhat similar. Really, the big difference is that Desjardins has 900 holdings. The Wealthsimple ones are probably only going to have, somewhere from 200 to 300. Again, it's okay. It's not ideal, but it probably is going to be a little bit cleaner because it's got fewer companies there. From there, what I would suggest in terms of my portfolios, the one that it likely replaces is this Vanguard cheap as fuck ESG portfolio, where I did these Vanguard ones. That this was US and then international, which was the rest of the world. And I think it'll likely replace these with the with the North America and then the ex North America, for the rest of the world. That to me, Vanguard, again, this one has, I think, 1,500 companies in it. This one, I think, has over 3,000 companies into it. So these really are going to be the ones that are hyper diversified. But my guess is that the Wealthsimple ones are, giving you very, very similar exposure, although with much, much fewer holdings. Okay, question from Steph here. If we already hold ETFs such as SDG or ETHI, would one of the main benefits of adding these be additional company/country diversification, since the methodology is different? So in terms of diversification, specifically with SDG and ETHI, SDG, I kind of view it as its own thing. That's the iShares MSCI Global Impact ETF. To me, that's kind of it's its own. That's more of a doing more good. So I wouldn't compare that. That to me is kind of separate. From there, ETHI, really the diversification benefit is going to be that with ETHI, it is cap weighted. So we do get a lot of exposure to the biggest companies in here. I won't even look at all of them. I'll just show you the top 10 because this tells you what I'm talking about, that it really is cap weighted. So to me, the biggest diversification is not going to be so much the exposure, the sector, or the country. There would be a little bit of that, but mostly overlap. Really, it's going to be about the different methodology, this idea of cap weighted versus this multi-factor approach. That I could see an argument to be made there that there is a benefit to diversification by having both of those approaches. That historically, the multi-factor approach, the academic evidence suggests that will be more optimal over the long term. But over the last few years, the biggest companies have kicked butt. Like they've done so well. So to me, you know, if you did want that diversification, it would almost be on the company weighting side and those two different methodologies there. That said, you know, it's been a concern for so many people that ETHI is so heavily in the US, and I think this is a really big concern. What we could potentially do is to look at the North America, the developed markets ex North America as a way of sort of propping up that rest of the world. The only issues is that again, this is developed markets. When it comes to ETHI, it's developed markets only. Notice no China, India, Brazil. So there is still going to be the gap of emerging markets, right? And we are starting to see this with a lot of the ETF families that are coming out. There's just no emerging markets. I think a lot of the fund companies have just said, you know what, it's super, it's just really challenging to do ESG in emerging markets, so we're just not going to do it. So, you know, it's an interesting thing, but obviously more options, it gives us more possibilities, more ways to do it. I wouldn't want you to like confuse things, but you know, if you're looking at ETHI and SDG and being like, I'd like to diversify it a little bit more, I do feel that you would benefit from some diversification by adding in these two into the mix as well, although you certainly wouldn't have to. Shiraz here is saying, I've been good on Wealthsimple. Black, in fact, good job getting to the front of the queue on that customer service now. A good 2+ years now, socially responsible. Yeah, so you are switching to this. So you've already switched to this. If you were in the Wealthsimple SRI portfolio, they did it automatically for you. And this does have impacts. One of the things that I've been looking at is the assets under management for the Jansi Social Index, which used to be, this was in the old one. And at its high point, I saw this at about $130 million under management. And then in the last 2 days, it's dropped back below 100 million. I remember I wrote a tweet to iShares and to Sustainalytics when they crossed 100 million. I was like, congratulations, you hit 100 million. That's such a big deal, like digital high five. And now they're back below 100 million because all of Wealthsimple's SRI clients have swapped over automatically into that new portfolio. So it is what it is. You know, if you were a client with them before, you probably like this new portfolio better, although again, you know, it's going to be up to you. I will give them huge kudos. I think they, you know, really did take things further in the right direction. Duncan, have they published anything on historical performance? So no. So this is one of the frustrating things for me, because these are custom indices that they built, Solactive built these for them. There really is no, you know, I take that back. It looks like they did back test these performance. So the tricky part is going to be, I don't think I can chart them against anything. So it looks like they just give me this chart. This would be a huge grain of salt because everything would be back tested here. And that it's going to be really hard for me without any ability to compare it. Let me play around with it. I wonder, like sometimes these things do have a little code. So there is this ISN. Do they have a little lookup? Let me just see if by chance I can get it on Morningstar. No. And let me just check morningstar.com. And sometimes the US site is just a little bit better with these ISIN codes. No, it's not giving me anything. So, you know, I'll keep playing with it. You know, if I had a Bloomberg terminal, I would be able to look it up. I don't think I'm going to be able to get it on any of these platforms yet. So we're going to have to wait for this. Okay, cool. Yeah, Gail, ESGV is not super green. I know it only gets rid of a few things. So, you know, you can see why this is the trade-off, more diversification, but more, you know, not so great companies versus less diversification, but a lot squeakier clean. Mark, yeah, absolutely. These fees seem close to those of the iShares Advanced I spoke about a few weeks ago. So pretty much par for the course. So you can see there's this new equilibrium between BlackRock and Wealthsimple really pushing these fees down. This is such good news for us sustainable investors. For the longest time, it was a major trade-off that the fees were so much higher. And so it just makes me so happy to see those fees come down. Shiraz, thank you. You're welcome, my friend. Thank you for participating and contributing. Natalie, I have all my savings in this, so thank you for this webinar. You're welcome. Hopefully Wealthsimple, get this, send this out to all of your clients. Put me in your newsletter. If this is an educational resource for people who own this, really, really happy to dig into it. Again, we're a little bit limited with the information that we have right now, but we are going to get more info in the coming weeks and months.